Arbor Realty stock, ticker symbol ABR. This stock is up almost 10% on the year-to-date chart, which is quite interesting since the overall market is up only 4%. ABR beat on both EPS and revenue, which comforts me a lot of course. People love ABR because of the dividends, and with reason. Right now dividend yield is at 10.6%, which is of course an insane number. It's also growing at a high pace of almost 17% annually. But does this mean that ABR stock is a buy at current prices, or is it a dividend trap? Well, in this video I'm going to show you real quickly what ABR does. The most recent earnings report, the fundamental analysis, dividends, returns versus the S&P 500, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does ABR do? Arbor Realty invests in a diversified portfolio of structured finance assets in the multifamily, single-family rental and commercial real estate markets in the United States. The company operates in two segments: structured business and agency business. When we check the most recent quarter highlights, we see that ABR had a $0.49 net income per diluted share and distributable earnings of $0.6 per diluted share, representing a 67% payout ratio. So right off the bat, dividends are looking safe. They declared a cash dividend of $0.4 per share, which is in line with the previous dividend, which is quite interesting since they used to increase the dividends every quarter in the past couple of years. When we check the revenue, we see that total revenue has a decrease around 20% year over year, which is something that concerns me a bit, especially since total expenses increase almost 100%. So that's definitely something to keep your eye on. Net income also decreased significantly, and of course the earnings per share as well. They issued a bunch of new shares to raise capital, so that's also an influence here. But of course the company has a lot of positive things as well. As said before, dividend payout ratio is at 67%, which is what most people care about with this company. They have 10 straight years of dividend growth and the lowest payout ratio in the industry, which is kinda important for this company. They also have leading shareholder return in the 3 and 5 year period of 7% annually on the 3-year period and 80% annually on the 5-year period. And last but not least, return on equity is at 18%, which is also very impressive. When we check the breakdown of the company, we see that bridge is by far the biggest loan type with 98%. Multifamily is by far the biggest asset class with 91%. They also have a smaller portion invested in single family rental. And now that we know more about this company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. And let's continue by diving into the fundamentals. ABR is a 2.6 billion market cap company. PE ratio is at 8, which could indicate that they are undervalued right now. But it has to be said that companies like ABR tend to have lower PE ratios in general. Later in this video I will show you my 3 price targets for Arbor Realty, so make sure to watch until the end. Because PE ratio is only telling a small part of the full story here. Revenue is at 619 million, and in this graph we see that the revenue went up in the long run. During the lockdown periods, revenue skyrocketed, and right now revenue is still going up significantly, so that's very interesting. Margins are going down since 2021, which is something to keep your eye on. But it has to be said that it's around the margin that was pre-lockdown period, so it wouldn't surprise me if it's going to be steady and consistent from here. EPS is also going up in the long run, but it's not really steady and consistent. Nevertheless, it comforts me a lot to see that it's going up. Price to sales ratio is at roughly 2.5 right now, which is pretty average for these type of companies. But it has to be said that it's increasing quite a bit over a longer period of time. Price to free cash flow is going up and down quite a lot, and I don't feel comfortable saying something about this number since it's a bit diluting in my opinion. Analysts expect EPS to decrease in the next 2 years, but after 2025 it's expected to increase again, so basically it's flat for the coming years. Revenue is expected to grow quite a bit in 2023 and 2024, but in 2025 it's expected to decrease, which feels a bit random in my opinion. Current ratio is at 4.39, which is very high to be honest. You want this number below 2 with these type of companies. Total debt is sitting at 13.5 billion, and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now total cash is sitting at 500 million, so they can't pay down a big chunk of their total debt, which is something that I don't like. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And in here we see that free cash flow is going up in the long run. To me this is one of the reasons why I love ABR. Their free cash flow is growing at high numbers right now. But the thing that I don't like are the shares outstanding. It's going up quite a bit in the past decade. To me this is very important. It means when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. But it has to be said that companies like ABR issue new shares to raise capital. This is something that you will see quite a lot within this industry. Dividend yield is sitting at 10.6%, which is an insane number of course, and obviously one of the main reasons why people invest in ABR. Annual payout is at $1.6 and payout ratio is at 67% as we saw in the earnings report, and not the 94% displayed here. I prefer 50% or lower, so right now they have roughly 33% left in cash to buy back shares, pay down debt, research and development and all other things. It has to be said that companies like ABR tend to have a higher payout ratio, so it doesn't concern me at all. The 5-year growth rate is at 16.4%, which is really good. And they grew the dividends for 9 years in a row, very impressive. Overall a great looking dividend scorecard, but how about the historical returns? I decided to compare Arbor Realty stock with the overall market, in this case the S&P 500. Next to that I added SITC and HIW. On the 5-year chart we see that ABR had a 177% return including dividends, versus the S&P 500 returning 59%. ABR beats the S&P 500 by quite a margin, but also two competitors as well. On the 1-year chart it looks pretty different. ABR still has one of the highest return compared to the others, but the S&P 500 had a minus 3.5% return. On the 6-month chart it's ABR that's having the highest return. The S&P 500 had the second highest return and both competitors had a negative return. On the 1-month chart we see that all stocks had a negative return, but ABR did best with only minus 0.5% return. So bottom line, ABR did beat the S&P 500 in the long run, and also some competitors. To me this looks pretty interesting, but is ABR still a buy at current numbers? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 4%, 5% and 6%, since I think they will increase their revenue at lower numbers versus the historical averages. Next to that it's also based on the analysis, expectations and the current outlook. Profit margin I'm filling in 44%, 46% and 48%. And for the free cash flow margin I'm filling in 46, 47 and 48. For the PE ratio and the price to free cash flow I'm filling in 8, 10 and 12. This is because companies like ABR trade at lower multiple of earnings and free cash flow. So that's something to keep in mind. It wouldn't be fair to work with higher numbers here in my opinion. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now ABR is at $14.6. I hit analyze and we see a few green numbers. We have a low price target of $13 to $14, which is a small drop. We have a mid price target of $16 to $17 and we have a high price target of $19 to $20. To me the mid price target is the most justified here, since I expect the company will face slowdown in revenue versus historical numbers, but not as much as we are seeing right now. Based on these numbers, ABR is undervalued. My final conclusion is that complicated businesses like ABR can be a high risk, high reward ratio. With a 177% return in the past 5 years, you easily beat in the S&P 500 by triple the margin. Most investors use these stocks to increase their average dividend yields and have that high dividend income. In terms of valuation, it doesn't look bad to me, but it has to be said that companies like ABR are not always that interesting in terms of value. Most of the times, companies like this trade sideways over a longer period of time. And the dividend is going to bring in the returns, which is all fine by me. For now, I think I will add a few more shares this year, since I do think it's still an interesting company. But of course, there are some risks attached to this one. That's also why I have a cap on 5% share in my portfolio for companies like this. I use the dividends to invest in other companies, which I think is a great way of increasing the value in your portfolio. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.